Hello, everyone, and welcome to your on-chain update for the 14th of January. And man, have we had a rally. How good is this? We're back above 21,000 at the time of recording. It's just fantastic to see. I mean, we've been talking about putting in some kind of a floor, and I'm not mad at the result. So, look, the real question is, does this rally have the juice and the legs to really turn this thing around? Now, um, it certainly adds a little bit more probability towards the bottom, right? The tick, the absolute tiniest, price point that we're going to get to this cycle. There's a little bit more weight to the fact that could be in at this point in time, simply from the fact that we've essentially erased all of SBF's malfeasance, both in terms of the reality of it, but also the price impact. We've essentially recovered the entire FTX candle, so this is a fantastic sign. But what I want to do is make sure that we all stay nice and grounded and just really cover the some of the metrics that are telling us that we are in good stead, and some that are telling us that just sit tight and keeping ourselves anchored to a sense of reality. Again, we may well have the bottom end, and we may well start to trend from here. But at the very least, we'll have a toolkit to help us understand what's going on at what point in time. So we're basically looking at, have we returned from the dead? And we're going to look at the indicators of health and market strength, and we're looking at indicators that are also yet to fire off. Now you'll find all of these. We actually at Glassnode, as of literally 15 minutes before recording this video, rolled out the dashboard that you guys have been privy to for some time. So we're going to explore that signals dashboard with all the different fancy colors. That has recently gone live. You'll find it under signals if you're a Glassnode T2 member, and you'll be able to access all of those. But as usual, you guys get the inside scoop. Okay, so the first thing that I want to look at is our on-chain cost bases, because you'll see a whole bunch of people tweeting about this. We were talking about this a couple of weeks ago, so you guys were also fairly privy to this, that our key levels to watch was the realized price, which also happens to coincide with the 200-day moving average, about 17, sorry, no, that's my wrong cursor there. That was at 19,700, and the 200 days at 19,500. So given that we have now done this really nice little mini parabola, and we've actually taken both of those levels out, the next step is, do we get a retest of that 19,500 and a convincing bounce higher? I do not want to see us fall back down below the realized price and the 200-day for any meaningful time frame. That would not be a great sign, and that would essentially say that we've probably got some downside left to go, to be perfectly honest. I don't think that we will get back down and wipe out the 15K level. However, we do need to just be aware that that's a key level to watch. Now, in terms of some market structure, you can see here that our short-term holder back in 2018, our short-term holder cost basis dives really heavily. That is all the coins getting capitulated down the lows, and here's our SBF FTX inspired version of that. We've seen that dive down of the short-term holder realized price. We also saw a dip in the realized price itself. Meanwhile, the long-term holder in blue tends to form this nice little ceiling. During the April Fool's Day candle we had back here in 2019, we busted through all three at once, and it was off to the races, at the very least for a couple of months. Now, remember that 2019 was a fairly challenging period in the sense that we had this initial rally. Everyone was pretty excited. We had another year and a bit worth of bear market ahead of us. So it's worth keeping in mind that we could very well have a 2019 in front of us. In fact, that's kind of my base case at this point in time. We haven't quite taken out the long-term holder realized price at 22 and a half, but we've sure given it a good crack. So we have a pretty similar market structure, to be honest. But you can see the Gusta, which has just wiped out the short-term holder cost basis and the realized price / 200-day. Holding up and above here is a good sign. We attempted it back here in, when was this, August, and we didn't hold it. We attempted again here in September, didn't hold it, and then we got firmly rejected when FTX came into the mix. Now that we're above it, let's see if we hold and stick the landing. Now, moving on to our signals view. So this is where we're trying to ground ourselves and say, cool, we've got some nice little price action. What does it mean? Do we actually have the trend, and do we have the market strength to justify this as a reversal? Now remember, the construction of this particular model uses 4 different topics. Green is pricing models, yellow is on-chain activity or network adoption, blue is profitability. We want people making money in this market, otherwise what's the point? And in the pink curve is supply dynamics. We want to see that wealth transition to the old hands, and then they have the conviction to actually spend into that strength. There is, bull markets. The reality of the situation is that bull markets are a process where smart money sells to new hands because there's new hands coming in. If there's no new hands coming in, then we're just basically trading amongst ourselves. And what is the point? So generally, this is how markets and the Bitcoin market tends to recover and move back in and transition. So you can see here that through the 2018 bear, it went pretty dormant. We had very, very few of these signals firing off. And it was only as we came into that 2019 peak that all of these things really lit up. And we had a bit of a rally here through May, June, July. You can see here again, the full-scale bull market has most of these things firing off, and we are off and away. We had some of these, not all of them, some of them firing. There was no on-chain activity. See the no yellow during our second pump? This is something that I will never make that mistake again. Pay attention to this. Note that the blue profitability only fired off during this peak. People literally took profits and put the top in. There was no on-chain activity. There was no good price performance. There was nothing aside from people literally selling that peak. So that blue there is actually telling you information. Now, where are we in the current market? We've got both of our pricing models having now broken above the 200-day and the realized price. Both of those are now firing. So we've got 2 on the green. We have 1 on the pink in terms of the overall supply dynamics. We'll talk about that in a second. And we have on-chain activity in terms of new addresses firing off. So we've kind of got a couple of subsets. But as you can see, this isn't exactly full of color. So we've kind of got a couple of metrics firing, but we don't yet have a full-scale trigger, right? We've got the initial burst, but we actually need to see the follow through. So definitely time to pay attention. We want to see this thing ramp up with some gusto. If it doesn't ramp up, it looks more like this pump. It looks more like this pump. Having a couple of these things in play is okay, but you kind of want a bit of follow through from at least a good chunk of them, right? Let's explore them one by one. Now, the easiest one to look at is our pricing models, right? Now, this one here, again, these dashboards and tools are designed not to help you find the bottom tick, but to help you navigate the late stage of bears, right? They're not trying to find the bottom. They're trying to find when there's a truly healthy trend in play. So we've got, obviously, both of our pricing models are now fired off. We've got our first green bar of the year, right? First green bar of 2 years, in fact. So quite a sight for sore eyes. Nice to see. We must stick the landing. So if this thing triggers off again, that means we've fallen down below at least one of them, and that would be a cause for alarm. On-chain activity. This is the one that is actually firing. You can see that we had a burst of activity following the FTX disaster. It has pulled back towards the yearly baseline. So this is the monthly versus the yearly. What we tend to see is that during you can see here in 2019, even though it was a bear market, we had growing on-chain activity. So it was a strong signal that this bear market actually had some kind of fundamental strength behind it. Despite the fact the price was getting lower, we were actually seeing fundamentals improving, which is why this thing fires off. Now, we had a little bit of a burst here, but you can see here, I mean, this is the thing, right? Yes, this triggered, but you can use your engineering judgment to say, yeah, it's pretty lackluster, right? Same as this thing here. We've got an uptick. We've now got it pulled back to the yearly, but I'll tell you what, this price rally could well give us an extra kick higher. That's not a bad thing. Now we start looking like we might actually have a trend if this does get some momentum to the upside. Likewise for this one here, we start getting some momentum to the upside. Let's see how she goes. On the fee front, we do not yet have blockchain congestion in any way, shape, or form. The Z-score for this thing is currently sitting down below a value of, well, basically it's negative, which means that we are below the average in terms of standard deviations from the norm over the 4-year cycle. Basically, the blocks aren't full. So if we get full blocks, that would also be a very, very good sign. This is the missing piece of the puzzle when it comes to the on-chain activity. We don't yet have fee congestion. And fee congestion is actually a pretty good sign. You can see it started picking up here in 2019. So it's generally a good signal to actually see whether we have some kind of resilience in this thing. But again, you've got to look at these things in context. Profitability. Now, this one here, you really don't hear that many people saying, gee, I love this bear market. I just love losing money. Generally speaking, people want to talk about assets and awareness builds and all that when things are profitable. It's very, very rare for people to be too excited about bear markets, unless you're me, in which case you see Bitcoin in a bear market and you say, this is exactly what I wanted to see. Now, what we're looking at here is the aSOPR. So the nice thing about aSOPR is it only looks at spent outputs. That's UTXOs. It doesn't care about coin volume in any way, shape, or form. So if a shrimp spends at 10% profit and a whale spends at 10% profit, they're measured exactly the same. 10% profit on both of those. So what we're looking for there is a spread, a very, very wide, all user encompassing spread. So aSOPR gives you a nice cross section of the whole market, irrespective of coin volume. Now, on a 30-day moving average, this is nice and slow. And again, we're looking for that high conviction. We actually want to see this thing reverse before we get too excited. And you can see that once it does reverse, 2016, 2019 for a brief period, but then into 2020, when it does reverse and people are actually making money, it generally is a pretty good sign that we're in some kind of a bull market. And likewise, when we're below one, we're in some kind of a bear market. Now, we haven't yet seen this reverse. On shorter time frames, it's starting to. So this is one to pay attention to. If we actually do get the tick over, that would be a good sign. And its brother is basically the realized P&L ratio. This one is the exact same concept, except it does factor in coin volume. If a whale is spending, they're just simply going to have more weight than a shrimp. And very much in the same, we pull back to a full detox level. You can see here pretty much a full detox level on the 30-day moving average. And we are in the process of trending higher on smaller time frames. We've got some upside momentum. This is one that we're waiting for full confirmation. So if you think about this, if our pricing models hold the line for 2 weeks, if our profitability metrics start to tick higher over 30 days, if our blocks start to fill up, you can see how this gives you a bit of confidence that the trend may in fact have some legs if we get all of these things firing. For now, we've got some of them firing, but it's kind of in that like speculative phase, I would say. We haven't quite got the full confirmation. And again, the model is not there to pick bottoms. It's there to be confident. It's there to give you the tool set to have some kind of grounding anchor, right? Waiting for these things to fire off is actually a nice way to just manage a bit of risk. But at the same time, we're starting to see that trend. So we can start paying attention to these one by one. Now, these ones are some of the ones that are in fact firing off. This is the RHODL Multiple. Basically, what we want to see is 2 things. One, this model will pull back to a very, very low level when we have a full detox of holders. What that means is that all the speculative buyers have been flushed out and wealth has transferred back to the hodlers. People have held their coins for 1 to 2 years. So a very low value means we've got a saturation with hodlers. Check mark number 1. Check mark number 2 is we actually want to see this thing counterintuitively trending higher. Why? Because the smart money is going to take profits. That's just a reality of the situation. Bull markets don't happen without someone taking profits, and those people who are taking profits are generally the smart folks. Now, the smart folks don't take profits when there's no buyers. They have a good read on the market. What they're doing is they're taking profits and transferring part of their coin back to new demand, which signals that there is new demand. And essentially, we're looking for, are the smart money literally selling their coins? So this thing will fire off when we actually have an uptrend over a 90-day period for this metric. It's telling us that the smart money is in fact taking some kind of profit and the market isn't nuking itself, which means that we have inflowing demand. And you can see that this thing here really starts to change behavior. Note here, as we break the previous all-time high, this thing rips into a full-scale uptrend. As we broke the all-time high here in December, this thing rips into a full-scale uptrend. So the steeper that this thing is going, the more that hodlers are essentially bailing out. And you can see that we also get these nice little peaks that start to form through cycle tops as well. So it gives you a series of tools, but essentially this one is firing because we do have this nice little uptrend, which is telling you that there are profits being taken, and that's a good sign. So the last one that we're going to look at is the supply in profit 30-day trend. We covered this in our article the other day, where what we're looking at is, did we have a nice firm foundation of coins that were distributed by others, accumulated by somebody else, and thus when small price increases occur, do you see more of those coins go back into profit? Now, if you think about it, there's actually 2 levels to this. These strong uptrends in supply and profit, this is literally how many coins are in profit. You can see that this climbs as the bull market carries on until we get to the previous all-time high. Until we get to the previous all-time high, this thing is essentially in an uptrend. Now, what happens when we get to the previous all-time high? Note that in 2013, these peaks were just kind of flatter. Following the all-time high in 2017, the peaks were kind of flatter. Here in 2021, the peaks were flatter. So even though price keeps going higher, the amount of supply and profit does not. It actually starts to flatten out. What's going on? This is the exact opposite. These very sharp rallies of small price increments in supply and profit means that there's a bunch of coins that were accumulated lower. We have a nice firm foundation. So this thing will trigger off, this purple sign will trigger off when we have a nice strong uptrend, meaning that coins continue to go into profit. And you may have noticed it's a little bit easier to hold your coins when they're in profit than it is when you're in a bleeding red loss. Now, during tops, this is a bit of edge for you guys. During tops, this flattens out. And that's because people are selling their coins from the lows up to the highs. So coins are now revalued to much, much higher prices. And as a result, those higher prices put less coins. There are less coins in profit for each incremental rally in price. So what we're seeing is that these flattening out of these curves is actually showing you that distribution is occurring at a much, much heavier rate. You will see this also show up when it comes to lifespan metrics and coin day destruction and all this stuff. So it's one of those several metrics that's telling us that we actually have, and look at this second peak here, a lower high. Less coins in profit at a higher price means more coins distributed to higher levels. We actually have a massive distribution event, which then creates the bear. So at the moment, we're starting to see this thing tick higher, but it is not yet triggered an actual full signal. So again, these things are a good sign. We've got some momentum, and I actually suspect that several of these models will start to fire up over coming days. But at the very least, we now have a framework and a set of tools that we can use to really model out and understand, does this bull market transition, bear market transition, has it got some legs? And if it's got some legs, it's time to start paying attention. So at least we now have a toolkit to really monitor across multiple different segments, looking for confluence and trying to provide that grounding anchor. If a bunch of these things don't fire off, at the very least, we can diagnose that and we have a toolkit to stay grounded. If they all start firing off, it gives us that extra conviction that at the very least, for the time being, the market trend looks relatively healthy. Anyway, hopefully that's useful and I'll see you in the next one. Cheers.